Hey, what's up, everybody? It is Wednesday, December 28th, and we had a bad day today. Bad day. As you can see, these quarterly tax drains, they're brutal. Every time we make some headwind on the upside, we get these quarterly tax drains. And it takes like 6 weeks to recover. Like, I think a week or two ago, I said that was the optimal buy window. I was wrong. I mean, yesterday we had a 17, almost an 18 billion drain. We had almost a 2 billion drain the previous day. So that's 20. I mean, Friday we had a drain. Then Tuesday we had a 17, almost an 18 billion drain. So we had almost another 20 billion drain, over the last 2 days. Today was net positive. I don't have the numbers for that. It'll come out tomorrow in the Treasury Statement, but it's not going to be enough. I mean, we're down now like 80 billion from, the that pre-quarterly, just right before that quarterly corporate tax drain on December 15th. We still got to recover like 80 billion. There's been 80 billion taken out. And I thought we'd see, I fall into this trap every time. Like, I keep thinking, okay, we get that drain on the quarter on the 15th or whatever, December, March, June, and September, and then we come back as the spending flows, replenish what was taken out. But it takes time. I mean, like I said yesterday, like, we're not seeing the same amount of government spending as we did last year and in 2020 with those big pandemic stimulus bills that we got. I mean, we're just, we're still, like yesterday I said, we're still like 25% higher than the pre-pandemic levels, but tax drains are higher too. See, tax drains are funny. The way the whole thing is structured is like, yeah, you have automatic stabilizers when the economy goes down. Automatic stabilizers like, unemployment benefits, disability, Social Security, all those things. They tend to expand. They get, the withdrawals, the outlays from those expand as the economy slows down. So it's like a safety net. But it happens the reverse way on the upside. Like when the economy starts growing like it did last year when it was growing really fast, then the government tends to be collecting taxes faster than the spending, and especially it cut the spending. So like proportionally, your tax haul is increasing faster than your spending, and this is just contributing to these drains. Man, if you could see, and I showed an image, a graph, here it is, of employment taxes. I mean, they're just shooting through the roof right now. So like, people are making money. They got jobs, they're working, but they're just getting drained through taxes. I mean, the government is making a killing right now, is making a fortune. The irony is that, the government's collecting back its own money that it has the monopoly power to issue, leaving everybody with less and less and less. I mean, look at how employment taxes are spiking up through the roof. I mean, this is a big part of what's going on too, that, as bad as these quarterly tax drains are, and then of course the big one on April 15th, I mean, you have this constant draining via the employment taxes, employment and withholding taxes. I mean, it's really hard to generate some upside momentum with the balances of the economy being drained out like constantly. I mean, we're just barely, getting back to the swimming pool analogy, like every time the pool starts to fill up, it just gets drained right back down again. So I mean, we're not going anywhere. That's kind of like why we're just grinding here. So today, not today, but I just saw today that fourth quarter GDP forecast from the Atlanta Fed is now back at 3.7%. I mean, that's good. You know, we had a 3%, was like a 3% third quarter. We got a 3.7%. This is what I was saying yesterday, is that, you know, if you look at the amount of fiscal right now, which I said is about, 25% higher than the pre-pandemic levels, I said it should keep us on a growth trajectory of about 2.5 to 3.5%. So over time, and don't forget, they just signed this 1.7 trillion, the omnibus spending bill. You know, it takes a little bit of time for those flows to start to, work their way into the economy. It's not like they sign the bill and the very next day, boom, you have this huge inflow. No, it's going to take a little time to see those numbers add up. And next year in January, we're almost there. Next week is January. We're going to see a very large, substantial increase in Social Security cost of living increase, maybe around 9%. So 9%, what with Social Security, like 1.2 trillion, you're talking about another 100 billion. So I mean, there's hope on the horizon. I'm just saying that these tax strain, and I fall into this trap. It's my mea culpa. I admit it. I'm guilty. I fall into this trap. I was thinking about this. I did the same thing back in September. I did the same thing back in June, where I anticipated like the turnaround from the drain was going to be quicker than what it really is. But the irony is, if you go back and if you listen to my videos from October, November, I was saying it could take into early January at that time. I just got a little bit overzealous when we had the drain, and then things started to look like they were turning around in terms of the flows. It takes a good 6 weeks. So we'll get a boost on Friday. Friday is the 30th, right? Friday's the 30th. Normally you get your big first of the month payments, those Medicare, Medicaid, military pay, veterans benefits, disability. That's like $100 billion day, payments day. Usually those come on the first of every month, but of course the first is a holiday, so we're going to have that on Friday. Friday should be a big net positive flow day, but it's still not going to be enough to replenish, the 80 billion that we're down. We're probably down a little bit less than 80 billion, because you got to figure with today's Social Security payment, the net flow, the net positive flow was probably something like around 25 billion. That's what it usually is. And so that gets us down to what, 55 billion. So we'll be close by Friday. By Friday, we should have a net positive flow, maybe of around 45 billion. So we're going to be close. We'll be 10 billion still has to go back just to get us where we were at on December 14th before the drain. You follow what I'm saying here? I mean, when they drain it out, everything starts to sink down, and then when they put it back in, everything starts to come up. I mean, you see it very clearly in the pattern of the market trading. Some markets obviously some are a little bit weaker, like NASDAQ right now is definitely leading on the downside. I mean, you got the Tesla situation, you have, China, and all that kind of stuff. Dow is doing better, even though I had a bad day today. S&P is doing better. They're still way off their October lows. But yeah, so that, that's basically it. I mean, it's going to take time. It's going to take time, but I'll repeat again. By the way, that 3.7% fourth quarter GDP, and then most economists are predicting a recession next year in 2023. That's going to be a sudden, to go from 3.7 to 2 negative quarters now, because that's the definition of a recession. I don't know what they're looking at. The Fed is tapering their rate hikes. two contributory factors to the better than expected GDP is that the trade deficit shrank, which I said that was going to happen because that's de-dollarization. That's literally de-dollarization, is that the foreign sector is using its dollars in exchange for, well, primarily oil and petroleum produced in the United States, and also they're making direct investment, foreign direct investment, like opening up plants and stuff like that. We just, what was it? A couple of weeks ago, we saw that Taiwan Semiconductor, they're opening up like a big, huge facility. They're going to build a big, huge chip manufacturing facility in Arizona. So, I mean, that is all contributing to, which I think is now, that's kind of like a secular trend. We're going to see the shrinking of the U.S. trade deficit as this trend continues of de-dollarization. See, again, the only way that the rest of the world can rid themselves of dollars, like it doesn't matter if China sells its dollars to Brazil or Brazil sells its dollars to, the UK, or the dollars still stay out there. The only real way to get rid of, for the rest of the world to get rid of their dollars, is to exchange them for goods and services produced in the United States. And then that means those dollars are actually taken out of the global system. Otherwise, they just stay there. They just change hands. Like if one country sells its dollars to another country or sells its dollars for gold, I mean, the dollars still stay in the system in foreign hands. The only way is when they exchange them for goods and services produced in the United States. And that's what's happening. So that was one factor that contributed to a higher reading or a higher forecast on fourth quarter GDP. The other thing was a slowdown in the inflation rate. All right? So inflation is a subtraction from GDP. Okay? And so when inflation slows down, that they call that the deflator. That's less of a deflator. So you get a more of a positive number on that GDP. So that's probably a trend that's going to continue as well, but not big, because the Fed is going to continue to raise interest rates, which I've said so many times. By raising rates, they're just setting a higher general price level for everything. I mean, they're really not allowing inflation to come down very much by virtue of the fact that their rate setting is just, setting a higher price level across the board for everything. But, that's central bank orthodoxy. That's mainstream economic thinking. That's the way they do things. As I've ranted about this so many times. Look at Argentina, look at Turkey, look at Japan, look at the differences there between policy and inflation. They don't want to recognize that. They don't want to acknowledge that. And so they continue on this path of, kind of just a flawed policy. It's not going to work. So that's the update. We're going to have to slog through this. It's rough. Plus you get, like right now, a lot of tax loss selling. I think that's just natural pressure as well on the market. But, we're just going to have to slog through this. And these quarterly tax drains and also employment taxes, I mean, they really have become a significant drag on. I mean, think about it. We're growing at 3.7% even with these drains. Can you imagine, like, if there were some tax cuts passed, or maybe this spending bill will increase spending enough to at least, moderate the negative impact from the tax drains? I mean, that would be good too. So I'm still positive. Like I said, we're averaging about $500 billion a month in leading spending flows. And that should be good enough for a 2.5% to a 3.5% GDP growth rate. And, I don't think that's a negative for the stock market. We're going to go through these periods of these drains now, and these drains really, when you think about it, they're kind of just technical. I mean, they just leave the economy, they leave people with lower financial balances, so you're stripping out potential buying power from the market. But then it gets replenished. It takes time, 6 weeks. Next time I'll remember this. Next time's going to be a big one too, because you get the March quarterly corporate tax strain, followed immediately April 15th by the big tax strain that everybody has to pay. And so, that you look at what happened this year. I mean, it took basically, we started coming out of that like in June, and then we got hit again with the June quarterly corporate tax strain. So it was it was a rough patch, man. I mean, that basically sent us down all the way into the lows in October. So we should get a bounce out of this in January, all the way up to, I would say, like February 15th is going to be a quarterly interest payment. And, we probably peak out around then, and then, the down cycle begins again. But we'll see what happens with this spending bill and how much additional it adds to the fiscal. I wish I could give you a better update than that, but that's just it. I mean, and if you're paying attention to this stuff, it should make a lot of sense. I mean, you really see this play out in the market. I mean, every quarter I warned about this going back to October. I said in December, and I think if you go back and if you listen to my videos in October, I said it would take maybe into the early January. I just got a little bit ahead of myself after that December 15th tax strain, and it looked like we were starting to come back a little bit. But yeah, I was right the first time around when I said probably into early January. Wish I had better news, but that's the way it is right now. All right, everybody. See you tomorrow. Bye.